Hi guys, welcome to my channel and my very first video. So the reason I'm creating this video is because I figured why not start making videos when I spend my time on these studying concepts and make something out of it, because people always say that you learn the best when you try to teach someone else, and I do think that there are people out there who are looking to learn the same thing I've spent time learning today. So I think why not just share my understanding with people and also hone my personal understanding at the same time. And I always wanted to make videos. I mean, VTubers is pretty famous out there, and I always want to be one of them, but I'm no good at entertaining or gaming. Right now, I think the best for me to do is make this opportunity worth both me and the audience time. So try to explain the concept I'm learning at the university here and make the best out of it. I'll make the most out of it, sorry. Also, English is not my native language. I will make grammar mistakes, so please bear with me. I'm sorry about that. So today we're going to talk about derivatives as in financial term, which is not the integration, derivation part, the math part. Well, there will be math in this, but they're not the thing, the calculus you think. So derivatives in financial terms, what are they? Well, derivatives, let's say it's a contract that the value is tied to one or more underlying assets, which are like stocks, commodities, gold, maybe, anything. And the contract, its value is tied to the price of them. And also, of course, there's a evaluation on the ability of the parties participating in this contract, because if someone enter the contract but they at the paying day they just disappear, that's no good, and we want to include that into our contract. But just for now, just understand it as a sort of contract tied to underlying assets. We don't want to dwell on this for too long. There are many types of derivatives out there, and today I'm going to try to cover forward and options and maybe something else, but the main focus will be forward and option. So what exactly is a forward contract? Cool. In the forward contract, the definition is that it gives the obligation to the participating parties that they have to buy or sell a certain asset for a specified delivery price at a specified maturing date. So what does that mean? Of course, just reading it, kind of not making any sense. Well, before defining that, I had to explain a bit of the terminology I'm going to use. I'm going to use long and short, which you always hear them in those financial movies like the Wall Street Wolf, where they're just shouting, long the stock, short the stock. What do they mean? What are they referring to? Well, it's simple. Long is, you can understand as a buy in the financial terms, while short is the contrary, which is sell. And in the forward contract, we have the obligations to buy or sell. So which means if you were to loan a forward contract, you must buy the certain asset for the specified delivery price. In contrary, short, you must sell it at that specified price. Well, at the maturity date, of course. So I'll give you an example quick. Let's say we have a forward contract on Tesla. Now, the delivery price we set in the forward is, let's say, $100, and the maturity date being 1 year. Oh, by the way, I noted the delivery price as K and specified maturity date as T. Let's say K is $100, T is 1 year later. What this is saying is that we both agree that in 1 year from now, I'm going to buy the Tesla stock at $100 per share if I am the buyer of the forward contract, or I've loaned the forward contract. And the opposite side would be the person who short the forward contract, basically saying they must sell the Tesla stock to me at $100 per share, no matter what's the actual price of that stock 1 year later. And now, if you want to look at the payoff of this forward contract, we can see here for the loan, for the party who loaned, or for the buyers, the payoff is ST minus K. Now, what does it mean? ST is the price of the stock at date T. So what is the actual price? So today would be 120, tomorrow would be 240. Maybe what happens overnight. Elon made some good investment, good decisions, and after that, maybe it halted. We never know. But ST is the price of the stock at date T, while K is the delivery price. And, whoops, what a good spelling mistake. Delivery price. And this one, you have to note, this one is fixed. See, upon entering the contract, we already set this price. It will not change until the maturity date when this forward contract is fully fulfilled, basically saying the obligations of buy and sell are fulfilled by both parties in this contract. This won't change, but the actual price of stock, of course, it changes. That's how the market moves. So for the loan, they will be buying at this delivery price. That's why they are spending minus K here. They are spending this money to buy. What they gain is the actual price of that stock, because after you buy that stock, you can then sell it in the market 1 year later at that price 1 year later. On the contrary, the sales side, well, not the sales side, that's a term for something, but the party who sold, they will gain the delivery price because, of course, the buyer spent this amount of money to fulfill the obligation in this forward contract. But also, they would lose the actual stock because they have to get one to give it to the buyer. So let's see how this contract do for buyers and sellers, like how good they are. Do they make money? Do they lose money? Oopsie. Oh, there's one thing is the forward price, but we will mention it later, much later actually. So just ignore it for now. Let's say we long forward. This is a buyer. It's the sailor. I'll just ignore the purple line here. I don't know why the number here, but anyway. So what we see here is the stock price here is moving. Well, actually not moving, but like let's say this is 1 year later. Now, the stock price, we never know. We don't know the future. It could end up anywhere on this white line because we don't know the future. Say, well, 1 year later, it end up here. But what is K? The K is the delivery price the buyers is going to pay to get this stock. So they pay K and get ST, and we are here in the green zone. What does green zone mean here? Well, green zone means you're making money because you spend K, but you actually get a stock that's worth more than K. Well, I should use capital T because I'm assuming it's 1 year later. It's more than K, so you spend less money to buy something that's worth more. You make money. Of course, it would be possible that, whoopsie, the stock just went kaput, and the price at the maturity date is actually lower than the delivery price. You might wonder, well, I have to spend money to buy something that's worth less than the money I spent. I don't want to do it, but you have to. This is a forward contract. We're talking about obligation to buy. You have to. Sorry about that, but you have to. You have to make this loss. And the short forward, the seller side, well, you can see it's exactly, you flip the graph there. You would make money, of course, this is capital T. You would make money if you are selling something, you sell a stock to the buyer that's worth less than the price you're selling at. So you make money if the stock price falls under the agreed delivery price, but also you will lose money if the stock actually performed well. But you will still have to bite the dust. Not bite the dust, sorry, not that terminology. What is that thing? You have to like swallow it. Yeah, you have to swallow the bullet. That's the expression I'm looking for. You have to spend more money to get the stock and sell to the buyer at this lower price, which is the delivery price we agreed upon. Cool. Now, how do we actually carry out the settlement of the contract? Do the sellers actually have to go to the market, grab a share of Tesla stock, and deliver it to the buyers? Do we have to do that? Well, let's see what's the difference here. So, physical means we actually go to the stock market, say, the sellers go buy stock because they're obligated to get one stock for the buyer, so they have to go buy stock. So whoever shorted, which is the seller here, have to spend money minus ST because they have to pay out the terminal value of the stock. They deliver it to another epic spelling mistake. Deliver it to buyer who loaned the forward contract at the price, delivery price. They have to do it. This is what it's agreed. So they gain this amount of money while the buyer spend the minus K to get the stock. The seller just bought from the market, and then the buyer, now they have the stock. He can sell the stock back into the market to make a profit. No, sorry, not minus. They actually make money here. A straight line never works out as I hoped for. So total, the cash movement for both sides, this would be ST minus K, and this would be K minus ST, which is exactly what we have here, the payoff for these both parties in the contract, buyer or seller, that's why. But, well, if we actually go to the market, grab a share, say we have 1,000 contract holders, the simultaneous going to the market, try to grab a share of Tesla, come back, deliver to the buyer, and the buyer all collectively sold their share. Well, of course, the market will react because that's a huge amount of buying and sell out of shares. We don't want that. And there will also, of course, in reality, there'll be transaction fees. You have to spend more to actually get the stock, and when you sell it, you have to pay certain fees. You don't make as much profit as possible. Oh, as expected. So in reality, we settle with cash. So in reality, we settle with cash. Basically, they calculate the difference, saying determine who has to pay who, and then deliver the money to the party who made a profit. Basically that. We are not going through the actual market. Not going through the actual market. I mean, of course, you wouldn't want to spend money on these transaction fees when you can just simply deal with in cash. Cool, that's forward contract. Now, options. What are they? They give you the possibility to buy or sell the underlying asset at a specified price, strike price, on or before the maturity date. Well, it's quite similar to forward contract, but we haven't noticed certain differences. First here, it's no longer an obligation. You can buy if it favors you, or if the outcome doesn't favor you, you can just not do it, not exercise the option. Just don't do anything about it, forget about it, it's gone, go with the wind. Or you can do the same if you were to sell the underlying asset. We will explain it more. The specified price is called strike pricing options. It's not delivery price. And it can be on or before the maturity date. There's a difference. If you have to do it on the maturity date, it's European options. And if you can exercise it on and before your maturity date, that's American options. Yep, that's the difference. So let's say there are two types of options out there. The basic categories of options. Call and put. Another two buzzword, what do they mean? Call basically suggests that you can buy underlying asset at the predetermined price, the strike price. And put means you have the possibility to sell the underlying asset at the specified price. So, and for each of them, you can either long a call or short a call. And the same goes for the put. Now, we have the total 4 combinations. That means we can long a call, short a call, long a put, and short a put. What do they mean? As we mentioned, long is buy, short is sell, if you understand that way. Long call means we buy a call. So we buy the possibility to buy. Well, it's a bit of like recursive, but bear with me. We buy a possibility to buy means if the price were to grow larger than the specified price. That means we can buy at the specified price and then sell it at the actual price. Then we make a profit if the actual price is higher than the amount we agreed upon. But unlike forward, if the price were to fall below the specified price, the strike price agreed when we enter the options, we can simply say, well, not doing that. I'm not going to exercise the option to make a loss. Why would I want to exercise it to pay someone? No, I'm not doing it. So bam. Not doing it means you forget about the contract, you make 0 if the price is lower, if the stock price is lower than that predetermined price. Now for the put, if you long a put, you buy the possibility to sell. Now what do you want when you're about to sell something at a certain price? Well, you hope the actual price is lower than the price you're going to sell it at, because you can buy the cheaper and sell at a more expensive price. That's why we make profit if the actual underlying asset's price at the maturity date is lower than the specified price. Well, I forgot to mention that the call and put example I have here is basically for, I'm explaining under the assumption that I'm talking about European options, but it should apply to American options as well. So yeah, if the actual final price of the underlying asset is lower than the price you agreed upon to sell, you're going to buy the cheaper ones and sell at a more expensive price, make profit. Good. But again, if the actual stock's price is higher than the price you're going to sell, you're not going to spend more money to buy something and sell it at a lower price. No, you're just simply not exercising it. Forget about the put option. Now, if we were to, you can buy a call, you can buy a put. Of course, then there's someone who can sell a call or can sell a put, which means we can short call and short put. What does the payoff look like for them? Well, it's exactly if you flip the long call around the x-axis of the payoff chart, you will realize that if the underlying asset is worth more than the agreed upon price, so basically someone buy a call options from you, and then they see that the final price of the underlying asset is higher than the agreed amount, they will exercise the call options and buy this underlying asset from you at a lower price, and then they will go on to sell this asset in the market to make a profit. But if they exercise that, you have to deliver the underlying asset to them, which means now you have to go to the market, grab whatever the underlying asset is at a higher price and sell it to the person who bought the call options from you. And again, if they don't exercise, if the final asset price is lower than the exercise price, you don't do nothing as well, because if they don't exercise, nothing happens. For put, similar reasoning. If they have the opportunity to make a profit, as in the final asset price is lower than the exercise price, they will do it, and you will have to do it for them. Basically, you will have to go, basically fulfill your part of the duty to fulfill. When they exercise the option, you have to do your part of duties to make that exercise going through. So what happens here is that, well, they see that, let's forget about K here. They see that the price falls under the price you can sell at. They're going to go grab some cheap stocks and sell you at a higher price. And you will have to buy them. And once you get them, you have to sell them at the actual price, which is lower than the price you bought for, and you make a loss. On the other side, no exercise, nothing happens. I know it's a bit repetitive, but I'm trying to explain it in like a very simple language so that make it easier to understand. I know it's repetitive, you can just skip ahead. Sorry about that, but I'm just trying to, again, I'm trying to hone my personal understanding as well as we go along. Now, you might wonder, well, for the person who long the call or who long the put, they make profit. Always. The worst case for them is they don't make any money. Wow, it's just, this deal is like you either make money or nothing happens. Who wouldn't want to do this? On the contrary, whoever short the call and short the put, they always lose money. Or the best case is they don't make anything. Why would anybody do that? I mean, if I were you, or if you were me, no, not you or me. If you were the sailors, you wouldn't want to do a deal that either lose you money or just doesn't do anything good for you. So what happens in reality is it costs money to actually buy the call. So for the buyers and sailors here, they have to spend actual money to get into this option. Now, when they spend money, the payoff for them shift down because they spend money initially. The starting point is no longer 0 as here. Here is 0. You spend nothing to get a call. You get the call and put for free. No longer the case. Spend money for it. So basically, we shift the payoff down by the amount they paid to enter this option. So what's the amount they paid? Well, it would be for call would be this. For put, it would be this. What are they? Well, these are quite a few mathematical expressions here. So remember, we're talking about the payoff at final day. Not final, let's make a more professional term. At maturity, that is when the option has to be exercised. Like the last possible day. You have to do it that day. If it's a European, you can only do it that day. If it's an American, that's the last day you have to do it. Now, C0 here means the initial price of a call. Cool. But what is this term here? Well, this is some forecasting factor. What is forecasting? Say, you have the money at date 0 and date t. You have the money here. So what is this money worth at date t if you have C0 here? Well, it's not the same amount, because what you can do is you can put the C0, this amount of money, if you didn't pay the option, you can put it in the bank with an interest rate R. So if you didn't pay these options, you would have C0 amount of money available. What you could do instead is to put them in the bank. They will generate interest for you. So C0 amount of money at time 0 is actually worth C0 times ERT, which is the amount and the interest you make along the way if you didn't actually invest in this option. And same reasoning for the put. Basically, just swap the C0 to P0. You get the same expression. Basically, you're saying if I didn't pay these options, I could have I could have just put them in the bank. They would generate this amount of money for me. Now that I'm investing these options, I lose the opportunity to gain the money I would have gotten if I put them in the bank. So they are the cost of entering these options, not just the initial price, but also the money you could have made along the way if you put them in the bank. Cool. Moneyness. What is moneyness? So when we say moneyness, we're talking about the spot price compared to the the strike price. What is spot price? Is the underlying asset's price at date t. No, not this color. Now we're talking about, it's possible that the current underlying asset price at the date t is higher, lower, or equal to the strike price we set previously. So, let me double check my note to make sure I don't give you false information. I'm sorry about that. I didn't want to write it out beforehand because I want to do it with you guys on the room. But cool. In the money, let's say we evaluate the current price and compare it to the strike price. If we were to sell the option, if we were to exercise the option right now, do we make money? If it's in the money, it means if we were to exercise the options right now, right here, we make money. So if the current underlying asset price is greater than the strike price for the call owners, so they will make money because they exercise the call, they buy the underlying asset at the predetermined strike price K, and then sell it at the actual price ST. And if ST is greater than K, they make money, right? They buy at a lower price, sell at a higher price. For the put, it's the opposite because the put owners would make money if the underlying asset fall under the strike price. So ST less than K. Because they can sell at K, which means if the actual price is lower than K, they can buy at a cheaper price, sell at a higher price. At the money, if you were to exercise right now, you don't make nothing. That's simple as that. ST equal to K. Out the money. By the sound of it, you know, if you were to exercise it now, you don't make money, you make a loss. It's out of the money. ST less than K, ST greater than K. And that's the moneyness definition. The spot price and the strike price comparison. Now, we go back to something called forward price, which I will explain in detail later. But forward price, we have the definition of an option is at the money forward if its strike price is equal to the forward price of the underlying asset. Now, you don't know what a forward price is yet, so just know that the at the money forward is when the forward price is equal to the strike price. We'll explain what is a forward price later. Now, before moving on, I want to talk about arbitrage. Arbitrage, what a nice word. That's how you make money. And even better, riskless profit. What does that mean? You make money without taking any risk. It's free money. Out of the sky, out of the thin air, it's free money. You just don't make a loss if there's arbitrage and you do the proper thing to capture that arbitrage opportunity. You make money out of thin air. It's riskless profit. Former definition is a trade that takes offsetting positions into or more offsetting securities to make a riskless profit. What is offsetting securities? That means ideally if you take this position, you make nothing. That's the ideal case. But in the term, if there's arbitrage opportunity, it means you are in the position where you are supposed to make nothing, but you actually make some riskless profit. Arbitrage. And it's rare, but if you see them, what you're gonna do is you do everything you can to capture that opportunity. And if you ask me how much you want to invest in that arbitrage opportunity, I would say everything you have. But of course, arbitrage is rare, and in reality, you want to bet everything because the market is volatile. You don't want to risk everything on it. But I'm not talking about investment, so move on. Hedging. What is hedging? So when you go to the market, you buy a stock, you invest, whatever, you never know about the future. So you buy, say, a Tesla stock today. You don't know what happens tomorrow. Maybe it crashes. Maybe it just goes sky high. You don't know. But you, of course, want it to go sky high. Like I assume everybody wants to make some money. But we want to prevent the case where the price actually crashes. So hedging is basically an action of counter the risks. You buy something else to counter that risk, so that even if the price dips, you still have a sort of like a cover up, like something that, like let's imagine if you fall like from the cliff, there's something under there to cut you, so it prevents you from falling to death, something like that. There are two types, and I can walk you through this in detail actually. So let's imagine we have a stock that's worth $100 right now, and we cannot sell until a year later. So You basically have a stock right now. Every day you monitor the price. You cheer when the price go up. You cry when the price go down. But other than that, you cannot do anything. And of course, you would want to cheer more than you want to cry. And ideally, you don't want to cry at all. What happens now is you want to protect yourself. Let's actually examine this. So, let's say $100. This would be the price of the stock you have. This would be a payoff, as in the money you make or the money you lose. 0. So, yeah. If the price of stock is $100 and the actual you remember you're holding a stock worth $100. Basically, let's say you spend $100 to enter this position. Now, if the stock price is $100, well, you lose nothing, you gain nothing. The payoff is 0. And now the stock price increase, you are happy, you make money because the price is higher than the money you spent to buy this price, because the price of the stock is higher than the money you spent to buy this stock. But you are going to cry if the price falls. But in this case, you have no protection. You are betting on the fate. You are hoping for the best. You are praying every single day, but nothing can really protect you. But now, hedging is you actually take some actions to protect yourself instead of like hoping for the best. The first option here I can show you is short a 1-year forward contract. So as you can see, this is the formula we derived above, K minus ST. And what happens when you short it? Go back to the graph. A forward contract. And if you short it, it looks like this. And you would wonder, what does this do? Well, you haven't noticed that a forward contract's payoff for you. Actually, if we go back up, you see a forward contract payoff. We're shorting them. So you see it's a straight line. And it should have a gradient of 1, ideally in this ideal case, because the price either go up or go down linearly. Now, we go to our graph. You have your stock here. You have the forward here. You notice that if the price of stock falls, well, you lose money on the stock, but you make money on the forward. If the price of the stock were to go up, you make money on the stock, but you lose money on the forward. And they both, if you can see, I hope you can see that the gradient of these two lines are equal, which means they combined should give you, let's find cover, should give you a straight line. Well, ideally you would choose forward such that the straight line is above 0. You don't want to guarantee yourself a loss. I mean, that would be a bit of a why. Why would you do that? Guarantee yourself a loss no matter what the stock price movement is. That is kind of rough. Say that now these two lines combine, you have like a fixed payoff. Now, no matter what happens, even if the price crashed tomorrow, you would guarantee yourself this amount of payoff. No matter what happens. You no longer have to bet on the fade, hoping for the best. This is what happens. This is what you get. But on the contrary, if the stock goes sky high, you are not riding the rocket with them. You are staying on the ground with the fixed payoff. Well, then I guess you would have to cry as well in that scenario because, well, everybody else went with the rocket, made $1 million, they retire, go to the beach, enjoy their life. Well, you here make this fixed payoff. It's just a bit of like income that you're happy, but compared to others who already retired, you might just cry as well. Now, is there a better option for us? Cool, there is. We want to protect ourselves when the stock crashed, but we also want to ride with the stock if they were to go sky high. We want to ride the momentum to make more money. What do we have? Well, what you can do here, maybe I should have copied this graph before I draw all of these, but now let's remove this fixed amount, fixed payoff, because we're not dealing with that. And not doing forward as well. This is what we have, the stock. Now, what we want. We want something that counters the risk if the stock price falls, but doesn't do much to affect our gain if the stock price were to go high. So we're looking for something that's off like this shape. So basically, if the stock price were to fall, we make money here. That will counter our loss on the stock. But if the price were to go up, we don't want a loss here. We just want it to like do nothing for us. We just want to take the ride with the stock and go together to the higher end of the price. We don't want to cause a loss. So is there anything that we've seen before that achieved the same amount of payoff, or a certain like a similar shape of payoff, which moved with the price of stock? Well, if we go up, examine all the derivatives we've seen before. Whoa, we see something like this, a long put, or like this. More realistically, you have to pay something to enter this put. What we see here is under the strike price, we make profit, but if the price of the underlying asset is larger than the strike price, we just simply have to pay the premium we paid for this option. It's pretty good for us in this case. So if we were to, I think I scrolled too much. Yeah, if we were to buy a put, which is called a protective put, we have something like this. Of course, you would have to, let's see if it's protective put, yes. So, but of course, the strike price, it's up to you to decide. You have to decide it what it is. Now, before the protective price, before the strike price of the protective put, you will gain on the option but lose on the not forward. You will gain on the option but lose on the stock. So basically you have a fixed payoff. This graph is not ideal because somehow the fixed payoff is under 0. You don't want that. You would want that, say that the fixed payoff is above 0. But well, please forgive me for that. But after the strike price, the put no longer costs you any loss. Now you're gonna go with the others, ride this momentum, and make money as the price of the stock rise. Lovely. You see a little gap here between the new hedged portfolio and the case where you only hold stock. There's a simple gap here. The gap is basically the premium you paid for the put, because of course you paid them premium for the put. It costs you some money, and in this case it's decreasing your gain because you spend money. But it's worth it because it gives you the protection here on this side that if the stock price crashes, you won't end up with the guys like here. You would end up here. It's good for you. That's hedging basically, and definitely there are much more than that, but just give you a little bit of flavor of what's going on here. Now we move on to the forward contract value, the contract value. So say a forward contract, what's the value of it? Like, how much does it worth? Well, for a forward contract, we need two informations to actually calculate the contract value. The first one is maturity date. When does this contract mature? The second one is, not strike price. I would rather say that's delivery price. And it's correctly spelled. Woo, let's go. Delivery price. And the condition, moving on, is we don't want any arbitrage opportunity. We don't want riskless profit if we were to price the contract. Not really price the contract, but if we were to calculate the value of the contract. I don't want to see the price of the contract because when we talk about forward price, it's going to be a bit of confusing. But let's say when we do the valuation, we want to consider in the case where there's no arbitrage. Of course, in the following computation, there will be assumptions such as no frictions in transactions, basically saying I'm not paying extra money just to do the transactions, and I can trade at the interest rate, blah, blah, blah. But the most important thing here is moving forward is no arbitrage presents itself. The starting point is at the maturity date. At the maturity date, the value of the contract is equal to the price of the contract. Now, what is the price of the contract at the maturity date? Say, at the maturity date, you buy the contract, you have to sell it right away because, at the maturity date, if you were to buy this forward contract, you have to exercise it right away because that's the last moment you can do exercise and you have to do it that day. And if you do it on the maturity date, what you make is ST minus K here. This is a formula we derived for the long position in the forward contract. And you see the capital T here, note, because it's the maturity date. That's the end of the world. You have to do it. End of the forward contract. Do it. And we denote the value of the forward contract T, small t, because we want that a formula that's not only working for the maturity date, but for from 0 to T. Anytime between the start of the forward contract to the maturity date, between the start and the maturity date, T can be expressed like this value. So the maturity, this actually should be T here, the capital T, because we are at the maturity. The value of this contract is ST minus K because there's no arbitrage. You cannot buy this contract at a different price than the money you're going to make from this contract. No arbitrage. Otherwise, it would make riskless profit. Just sell the overpriced, buy the underpriced. You make riskless money, infinite amount. Now, we have this expression here. We know the term the value of the forward. Now, what's the value of the forward contract at T between 0 and before maturity date? If we were to receive this amount at maturity. What we do now is we have to bear two things in mind. There's no arbitrage, and we replicate a product by producing the same amount of payoff. So here, in this case, we can long forward, which means we buy the forward contract, and we would spend this amount of money, the value of the contract. We spend this amount of money, the value of the contract, to get into the position, and at the maturity date, we would get this amount of payoff. Now, we want to replicate this payoff. As we say that we've broken down this payoff in two parts. S capital T and minus K, because for the buyers they have to buy the underlying asset at the delivery price and then sell it in the market with the actual price at time capital T to make a profit or loss. We don't know. So we want to replicate the actual price in the market for the underlying asset. The second is the money you spend to buy this underlying asset from the seller. What do? To replicate this, to replicate the actual price of the underlying asset, what we do here is we have to buy the asset at date T, because it's not capital T here because I'm at date T, right before the maturity. We want to buy it and then we sell it on the maturity date to make this ST. And we have to borrow money, borrow until maturity. Because what we want to borrow so that at the maturity date we have to repay minus K, because we are trying to replicate the payoff of this forward contract. We want to do the exact same thing. We want to get the ST minus K, but not using the forward contract. So we now borrow until maturity. And we have to discount the minus K, because if we were to repay minus K, we're not going to borrow minus K. So if we were to repay K, we're not going to borrow K at an earlier date, because if we were to put that amount of money in the bank, it would worth more than K at the terminal date. So discounting, we discount it ERT minus T, which is the time gap between now and maturity date. R is interest rate and the K. Now, as I mentioned, there should be no arbitrage, and we see that the payoff from loaning a forward contract and doing this is exactly the same thing, both as T minus K. That means the money I invest, the money I spend on producing these payoffs must be the same. Otherwise, arbitrage, because you spend different amount of money to get something that pay off the same amount of money. You don't want that. That's arbitrage. So what we have here is VT TK equal to ST minus RT minus TK. But now pay attention. We have the value of the forward contract on the left-hand side and the actual price of the underlying asset at date small t and a fixed amount of cash we have to borrow. Then we know the value of the forward contract at time small t, because we know the current price of the underlying asset and we know the fixed amount of money we have to borrow. So we know the current value of the forward contract. Well, law of one price, the definition, which is basically the thing I said, is absent arbitrage, two traded assets or portfolios that provides the same intermediate cash flow and the same terminal value must have the same price at all times. So basically what he's saying is, if you have two different traded assets or portfolios, they have exact same behavior. Like they pay you same amount of terminal value at the end of the portfolio, at the end of the investment, you get the same amount of money, and during the investment, at the exact same time point, they pay you the exact same amount of cash or whatever. The behavior is the same, then the price should be the same. Otherwise, it's just arbitrage. So as we shown here, the value of the forward contract at date t is same as the price of the underlying asset at date small t minus the amount of money we have to borrow. Voila, a good formula for us, and we love formulas. Now, what do we do if the price in the market deviates from what we calculated? As I keep mentioning, an arbitrage appears, you have to grab it if it appears, because it's riskless profit. You make money. What do? You buy underpriced, sell overpriced. What does it mean? If two things produce the same amount of cash flow and some of them is sold more expensive than the other one, you buy the underpriced, you sell the overpriced, you make the difference as a profit and riskless, because at the end of the day, the pay is the same. You can use the payoff from this sold portfolio to repay the payoff that you have to pay for the bought portfolio. Right. Now, to make it more apparent, let's do the money carrying, which is something we do here, the carry the value of contract to date small t from big T. We do the same thing, but with an arbitrage opportunity, so that we can see it much more clear. Now, let's say the value of the forward contract is the same we derived above, it should be here, plus a positive amount. What does it mean? It means the value of the forward contract is actually higher than it should be. Right? Note that we have a positive amount of deviation. So basically the value of the forward contract is worth more than it should be. So the forward contract is overpriced. I have to say, constantly talking is very tiring. I never realized. I respect my professors even more. Like, it's the first time I try to teach someone else, and I'm just already feeling tired just by like 20 minutes. Oof, please bear with me. I know it's kind of boring for you guys who know about this, but I'm just trying to explain much more detail so that people can get a better understanding. So yeah, sorry. Okay, forward contracts overpriced because it's worth more than it should be. So what do? We short the overpriced, we short the forward. Let's go. So the final payoff if we short a forward contract would be K minus ST, because we would sell the underlying asset, make the strike price, make the delivery price K, and then lose the money we spent to grab the actual underlying asset minus ST here. But since we've already sold a forward contract at date small t, we would make money, so it's a positive, and the value of the forward contract. And we do the same thing as we did above when we replicate the portfolio. We sell, because up here we have a long forward, but here we are shorting a forward, so it's just do the opposite thing. We sell the asset, we gain the current price of the underlying asset, but at the maturity date we have to buy back, and then we lend until maturity. So we lose some money here because we lend to someone else, but then they will have to repay us. They better repay us. Okay, voila. Nice, we have K minus ST here, so it's replicated. But you can see that the VTTK, it's actually ST minus E, the amount we lent, plus a positive amount, which is greater than the cost of reconstructing this portfolio here. You see this part is the same, but the money we made here, this is the money we made, actually contain a term that's positive, and it's greater than the money we spent here. So what does it mean? We made a profit here at date t. Very good for us, and you will notice that there's no risk because the payoff for the two portfolios are the same. They just counter each other. So what are we gonna do? It's not what we're going to do. We already done it. We made a profit here. This one. Strictly positive, riskless profit. You love to see it. You just want to grab as many of it as possible. Now, move on to the next. Another definition. Forward price. Let's go. I think you've seen it twice before, and I always say I'll explain it later. Now here we are. Forward price. What is a forward price? Let's first read the definitions. Forward price of an asset at date T with maturity date, capital T. Very important. Maturity date, capital T. And the forward price of that is a predetermined delivery price, K. Such that the value, which is the one we just showed you, the value of the forward contract at date small t is 0. Well, it's a bit weird now. Like, we want to, because the forward price make you think, oh, it's the price of the forward contract. No, it's not. The forward price and the price of the forward contract are totally different thing. The price of the forward contract is the valuation we had, like how much it's worth. And the forward price is a predetermined, fixed. It's a fixed, predetermined delivery price that we set when we enter the contract. It's like if you were to, let's say, you want to buy a stock and you want to enter the forward contract. You go with a person a party who sell the forward contract. You sit down and say, well, I want to enter the forward contract. They would come up with a delivery price to write on that contract. Where did they get that delivery price is what we're going to discuss next. But you have to remember that ideally, with no arbitrage present, this delivery price is determined such that the current value of the forward contract, the value of the forward contract you're going to make at the date small t, the day you enter the forward contract, is 0. So it is worthless at the day you enter, not at the day, at the moment you enter the forward. It should be worthless with a properly set delivery price. Yeah, so just remember, forward price is the predetermined fixed delivery price you set on the forward contract at the day you enter the forward contract. And the price of the forward contract is a valuation of the forward contract, and it changes throughout the lifespan of this contract. Now, we denote the forward price as F small t capital T because that means we determine this fixed delivery price at small t, at date small t, for the maturity date of capital T. And this is the expression we derived above, the valuation formula for the forward contract, and replace the K with the expression we have defined here. Now you see it's the same formula but with different notations. It's no longer K but F small t capital T. And more importantly, we set the value to 0. This is at date T, always getting my at date T, 0. Then we rearrange the formula, rearrange the formula, and we get a formula for the delivery price. Sorry, we get a formula for the forward price here. Now, what happens? I know you wonder, like, it's counterintuitive. Why, when we enter the forward contract, the valuation of the forward contract is 0? It's like, what it's worthless. Why do we enter a worthless contract? Well, let's say this thing. Let's say if we set up forward price such that the value of the forward contract is not 0, what would happen? Say we have a forward price set such that it's greater than the formula we derived here. So it's the forward price is higher than it should be. That means the value of this forward contract at date small t is less than 0. Because if we were to have ft capital T larger than it should be, then minus this term would result in a value of negative forward contract, a negative value to forward contract. So the price of the underlying asset must rise more than it should to make some amount of profit for buyer. See this? What do I mean by this? So say again, Tesla, the delivery price is $100 at date t. You are the buyer, I'm the seller. Buyer. So at date t, the price is 150. Well, you make, that means, well, lucky for you, you make a $50 profit. While me, as a seller at t, I would make a negative $50 profit, which means I lose $50. But this $100 at time t delivery price is supposed to be, but now we say that the ft, the price we set when we enter the contract is greater than this. Then say the price when we wrote on the contract, I did you dirty, I set the delivery price higher than it should be. I said the delivery price is actually 120. And what happens? Well, at the maturity date, the price of Tesla is still 150 because that's what happens in the future. But then since the delivery price is higher than it should be, you only make $30 profit. And me, as a seller at T, I only lose $30. So you see that you make less when the final price is the same, and I lose less. What does it mean? Well, this contract is good for me as a seller. It's good because I lose less and you gain less. It's good for me. So I, as a seller, this is more attractive because I will lose less, and you as a buyer, you wouldn't be happy because you should make $50, but now you only make $30. You wouldn't be happy unless you have some certain other different criteria to evaluate how happy you are with the contract, but you're not happy. Well, got some misunderstanding, but now it's sorted. Let's get back to it. So the price of the underlying asset as we said, must rise more than it should be to make the same amount of profit for buyer, as we just mentioned. So now it's less attractive for buyers and more attractive to seller. So now let's pretend as the seller. That means we are expecting to make some free money because according to the definition, if the forward price is not set as what it should be, there should be an arbitrage opportunity for us to exploit. So, and we are the sellers and the contract appears more attractive to us. It must be because there is an arbitrage opportunity that benefits the sellers. Let's look at it. So we short the forward since if the forward price we set is greater than it should be, bring it into this formula, we would have a value of forward contract less than 0. But in reality, when both parties enter the forward contract, they pay nothing. They both pay nothing. That means the price of the forward contract that's being sold, say 0, because none of the party actually pays anything. So when the forward contract is being sold at 0 and the actual value is less than 0, we say the contract is overpriced. Now, what we do to exploit an arbitrage opportunity is that we sell the overpriced and buy the underpriced. So we sell the forward contract, but as I mentioned, it's worthless right now at date small t, so we get 0. And the payoff would be the strike price minus the maturity date price of the underlying asset. And we replicate the payoff using the same way we did above. But here, notice that this is the amount of money required to replicate the same payoff. But if we substitute this inequality into this formula, we notice that the actual money we needed to replicate the portfolio is less than 0. I know intuitively it doesn't make sense, but let's say the computation that we sold the contract at 0, which it didn't cost us anything, and by replicating that portfolio to achieve the same payoff, we actually made money. So it's an arbitrage, and it made money for the sellers. So if the forward price were to set higher than it should be, it actually creates arbitrage opportunity that benefits the seller. So yeah, that means we have to price the forward price such that, so not price the forward price, it causes confusion. You have to set the forward price such that the value on the day we enter the forward contract of that forward contract is 0 to avoid arbitrage opportunities. Now, we agree that the value of the forward contract at date small t with a forward price f small t capital T must be 0, otherwise arbitrage. Now, we explain why this forward contract is actually attractive, because, I mean, you would ask, why would we enter a worthless contract? It has to make us something, so that it's worth getting into. Now, at date t, at which you enter the contract, sure, it is worthless. At a later date, though, it's no longer worthless. So we say at a later date theta, that's greater than small t, but not yet maturity. We have the value of the forward contract here. Please notice that it's not f theta t, so we are still using the forward price we set at an earlier date. This is when there's a movement uncertainty we brought into our payoff. So now we again use the formula we derived above and the definition. We set the value theta with a forward price set at date theta being 0, because let's imagine if we were to enter the same forward contract not on date small t but on date theta, the value on date theta would be 0. And this is just the formula we just derived above. Simply rearrange, we get s theta equals to this. Now, because the value theta, not because, it's just a formula with plugging the numbers here, but notice that the difference, you see the s theta minus the f theta t and ft capital T, they are different. That's the difference they have. This is where we bring the uncertainty into our payoff, because we are using a forward price set in an earlier date instead of set it on the day we enter the contract. Now, just substitute s theta, this expression, into the same formula. We get these, rearrange, we get a fixed term and a term that varies. So this is fixed because we already set the forward price and it's a fixed predetermined delivery price. It won't change. But f theta d, it does change with the theta, because theta is changing, so f theta t would change. This means this term could go positive, negative, or 0, but this whole thing here is your payoff. It's your profit and loss. Now, if we consider the case where the underlying asset pays a dividend, because up until this point, we only considered where the underlying asset is only traded at the start and at the maturity date. If we were to replicate the portfolio, again, very importantly, when we settle the forward contract, we don't actually trade the underlying asset. I'm just saying that if we were to trade the asset, because we did that on the purpose of replicating the forward, there was no dividend. But now, in case there is, and more specifically, now we consider the case where the underlying asset pays a non-random amount of cash, delta, at date theta before t. That is, if there is one extra payment, if we were to buy this asset, then they will give us dividend in between the starting small t and the maturity date, capital T. What are we going to do to replicate it? Remember, we are replicating a long forward, but it should be the same for short forward, as in the result would be the same. Now, we would pay the amount, the value of the forward contract, and we're using K here to express delivery price. We're happy to see, because FT capital T, it looks much more complicated. Now, the key thing is, as I mentioned, that when we do the forward contract, we don't actually trade the underlying asset. So at date theta, we're not getting a dividend because we didn't actually trade the asset. Finally, date t, capital T, I mean, st minus k. I hope you now understand why it is. Now we try to replicate this. We do the same mode when we try to replicate the long forward position. We buy the assets, date small t minus st, we spend money. Date capital T, we sell it, we get s capital T. But, now in between date theta, we get a dividend payment. Whoa, extra money. We love it, but it makes the replication not working because date theta should have a zero payment if you were to long the forward, but now you have a plus delta. Now, we will deal with it soon, just in a sec, but let's first replicate the minus k, which is delivery price. We borrow until maturity, the same mode. This is exactly the same thing as before. Nothing happens here because you borrow. Now you repay it. Now, we have to cancel out the extra dividend paid. I know it sounds frustrating because we got a dividend, why do we cancel it? But that's essential. We want to price a long forward properly. How do we cancel a dividend paid at date theta? Well, it's exactly the same as how you cancel the delivery price paid at the maturity date. It's a payment of fixed amount. It's the same thing. So we do the borrowing, but this time we don't borrow until maturity, we borrow until the dividend payment, which is date theta. So that we have to repay minus delta on date theta. This has nothing to do with date capital T because this transaction, this borrowing, has concluded before that. And for this, we are gonna do the same. The discounting here. Cool. Add them all together. We have very importantly, not capital T, but theta here for the dividend minus the amount we spent to buy the asset. This is 0. We are happy because it matches what happens at d theta for long forward. And this is st minus k. Cool. By the law of one price, what we can say is that vt t k should be equal to st. Note that we have a minus here, so we have to flip all the signs. Minus rt minus t k minus r theta st delta. Cool. And this is the formula we use to price forward if the underlying asset pays a non-random dividend once before the maturity date. The extra term here account for the dividend paid, because as you can tell, this part is the same as the previous version where there's no dividend, and this one is the present value of the dividend we get if we were to buy the asset. Now, what happens if we were to have multiple non-random dividends? I'm not going to do the carrying, but you can, with a bit of thinking, see that if we were to add some node here, they would do the exact same thing as the one, this row here. So what we would have for multiple non-random payment is this. As always, the first two terms is the same, doesn't change. It represents replication of the asset price and the delivery price. But now this is where it differs. It's actually going to be a sum of the present value of this dividend payment at different date. So equal to 0 to n, well, actually 1, with 1 minus r theta I minus t delta. Now this assumption that we keep getting a fixed amount of like this delta. But of course, delta can vary, but then you would have to sum them, calculate them individually. Like the delta is like a fixed dividend, but if they varies, we can simply break down this summation and just sum them individually. Theta I is a different date we get dividend. Yes, so there's abbreviation for that. Actually, no, not fixed. I can just simply do this. A delta I. So it's no longer fixed. Delta I is the dividend you get at theta I. That's better. That's more cohesive. Yep. Now we simplify this term. Actually, not including a minus sign. Simplify this term as this. This represents all the dividends, the sum of the present value of all the dividends paid throughout the time span of this forward contract. And up until now, we're talking about discrete case, where the dividend is paid at discrete date. Well, in case where the dividend, or is no longer, I guess it's no longer going to be a dividend, more like interest or a constant cash gain, then you would replace, say, the summation with the integral. But I wouldn't expand on that because myself need more time to understand that concept. And yes, I think that will be all for this video. I think it's already way too long, way longer than I thought. And as a fresh new YouTuber with the first video being an hour long, boring future price derivation, I would expect this video to get like maybe 2 views. But yeah, I hope you enjoyed it, and I hope my derivation was helpful. And definitely please point out any mistakes I made, because I'm sure somewhere, sometime, something I say doesn't make any sense, because it's the first time I do this. I'm sure at some point in this video I'm talking gibberish or my derivation is wrong. Please feel free to point it out. And I hope to see you next video. Thank you. Let's keep learning together.